Hey everyone, welcome back to the third day of the Economic video series. I'm Anu Arun, and today we'll be covering investing. So, what is investing? It's the allocation of money in a business or asset with the expectation of generating a profit or an income over time. Essentially, you're putting a small amount of money into something that will be growing exponentially. Therefore, you are earning a profit over what money you've put in, which is essentially what investing is, which is why people use the word for investing in risks and whatnot, because you're putting some of your own worth to get a higher reward. So here are some types of investments. The first one is stocks, which is the ownership in a company. You're essentially buying a small pie slice of a company, and a very minuscule one, by the way. And as they do well, your money increases exponentially through interest, and that is what you're earning back. Typically, this is the most standard way of investing, as there are many apps and whatnot that we'll cover later that helps you do this very easily. The second type of investments are bonds, which are essentially loans to companies or governments. This works in a bit of a different way, as there's going to be a specific bond holder who will be paying back your principal amount of money in a later point and be later paying on interest back to you in specific intervals, for example, monthly. These are specifically if the government has requests for something. For example, if you ever read about some history and like US history specifically, and they talk a bit about war bonds and whatnot, that's somewhat related to that. So the government does specifically ask you for these. You can, if you want, you can choose to, depending on your financial situation, but it is something the government typically asks you for. Next, we have mutual funds, which is collections of investments. Essentially, these are when, multiple investors, like you and multiple other people, pool together your money to make a bigger investment in something. And this can be towards, a bond or a stock, and typically this would be a stock here. Then we have real estate, which is basically you're buying more property, generate rental income. For example, a landlord. A landlord did buy an entire apartment complex, or maybe just a big home, and then they'd rent it out to other people. They wouldn't live in it themselves, but they'd rent it out to other people so they can earn money from this as well as whatever job they have. And finally, we have a couple of alternatives here, which is crypto. As you can tell, it's kind of like Bitcoin, very unreliable considering it's still a bit recent. And at the same time, it's very easy to scam people through online transactions. And then there's commodities, which is similar to real estate in the fact where it's other property and other sorts of physical objects that you can purchase at some high value. So here's some key principles when it comes to investing. You want to start early because you want to use compound interest to your advantage. Compound interest is essentially a very specific formula where the money that you put in, depending on how many years that you're going to continue investing in whatever it is, and how well the company or whatever you're investing in is doing, that results in the money that you'll be typically earning annually. So you want to obviously know that compound interest for each investment that you do is not the same. So you want to be able to calculate that specifically for every investment that you do, so you know how much money you'll be earning and if you'll break even. You also want to diversify. You don't want to be putting all of your funds into one commodity because you never know how well they'll do. For example, if most people who have been investing in Netflix used to be a really good stock, but now it's not as good, or at least it's kind of stagnant and the profit line isn't as significant. So you want to be sure that you're diversifying. And stay consistent because you want to be investing regularly. You can be small amounts of money, obviously, if you're not in the financial situation to do more. And you don't want to care too much about the smaller variations because, for example, there's obviously companies that have decreased a lot since the year 2010, but there are also many companies who have decreased a little and increased little, essentially fluctuating. And fluctuations don't necessarily mean they're going to be declining significantly. So it's good that you still continue investing in them. And finally, as I mentioned before earlier, you want to think long term. Avoid emotional decision making. Just because some random company appears on your feed and suddenly looks like they have exponential growth and it's super high and super large and you really want to invest in it, you should check their stats and see how long they've even had this growth. Because it could just be some trend that's making it happen. Like I know the Stanley company definitely had a trend in it because of their Stanley Cups, right? But obviously those are not in the trend anymore. So, assumingly, their stocks will not be similarly reflecting that. Here are a couple tools and resources that you can use no matter what age. For apps, we have Robinhood, Fidelity, and Acorns. These are apps that help you track your investments and invest your money. They also tell you early on, like what kinds of returns that you can get potentially. Very, very helpful. We also have some books, which is The Intelligent Investor by Benjamin Graham. I read this book before. It's a very good read. It gives you a good idea on the climate of the current market and genuinely the current economy. It's very helpful for when you want to specifically choose what sorts of things you want to invest in. And some courses you can look up online are Coursera, Khan Academy, and a new thing that hasn't listed here is Investopedia. They're very, very helpful with information on how to invest the first time and how to track trends over time too appropriately. So, you don't obviously continue investing in a company that's showing signs of decline in the future. We also have many of these resources for investing and budgeting and whatnot on our website, econetic.line. So make sure you check out this video and many other videos and articles on there. Thank you so much for being with us today. I hope you learned a bit more about investing. And thank you so much. See you in the next video.